This program is brought to you in association with First National Bank of Botswana. Should you take out a mortgage or a personal loan? As life would go, you've achieved everything you set out to. You graduated well, found a good job, have your car, and are now looking to invest in property. This might be the one and only home you'll ever own, so you're set on making every decision around it pan out the best way possible. And one of these decisions includes how you're going to finance this purchase. Two options, a mortgage or a personal loan. Let's start with the basics. A mortgage is defined as a loan that is used to purchase a home, maintain a home, or buy other types of real estate. While a personal loan, on the other hand, is a loan that does not require collateral or security and is offered with minimal documentation. So, which one of the two is best for you? With that small background, we have financial educator from Money Managers, Kumoetsile Kositsile, to dissect this topic. Kumo, thank you so much for coming on First Issues and affording us your time. We're talking to you today about mortgage loan and a personal loan. Let's start off by understanding the key differences between the two.
Yeah, I like that question because it's always coming up like everywhere. Okay, mortgage, personal loan. Key differences. Let's pay attention to this. Mortgage is secured debt. You are getting a mortgage because you want to buy a house. Right. So that house that you bought is the security. Personal loan is unsecured debt. When you go and get a personal loan, nobody is going to ask you what are you going to do with the money. Unsecured. Secured, unsecured debt. Right. And then when it comes to pricing, because the other one is secured, the other one is unsecured, the risk profiles are very different. Because this one, there's recourse. The property, yes, it's low risk. And because it's low risk, low pricing, cost of debt. This one, because it's unsecured, there's no recourse. It's high risk, therefore, that risk is going to be reflected in the pricing of the loan. High interest rate. Those are the main key differences between the two. And also, if we may put it this way, this one, the use is, you know what you're getting it for, is for the house. This one is unrestricted use. So nobody's going to ask you, what are you doing with the personal loan? Nobody. You just get the money in your current account. This one, the money doesn't come to you most of the time. If you are buying a house, the money is going to be paid to the seller, not to you. So you know where you're going to touch the money, unless maybe there's a few changes in there. That's when you are going to get that. But personal loan, it gets straight into your current account. So the risk profiles of these two are very different. That's the main difference.
What are the advantages of either one of these loans?
For me is because issues of money, like we say, they're always personal. Everybody's going to come with their own reasoning and circumstances and all of that. But for me, I say because of the structure of the mortgage, I'm always going to lean towards a mortgage. The most contention that I have with people about the mortgage is they say that it's long term. Because mortgage, you are looking at 15, 20, 30 years, depending really on your age. And then personal loan, we're looking at 60 years, maybe there's one bank offering 70 years. So short term, this one is long term. Because this one is long term, it means that the loan is spread over a long duration. And because of that spread over a long duration, overall, even though the interest rate is lower, overall, you end up paying a lot of money because you are paying small money over a long period of time compared to a personal loan where the interest rate could be high, but because of the shorter duration, you are in and out quickly. Therefore, the overall interest that you are going to pay is going to be lower. But based on the pricing, I would go with the mortgage. And what I can do is, if I can afford to pay within 5 years with a personal loan, same amount, I will do the same with a mortgage and save myself a lot of money. I always say that when you go and look for a loan, that installment that you are given is not cast in stone. It's not like the final amount that you have to pay. It's the minimum that you have to pay. Even if you look at your loan agreement, always be written minimum. So it means that you have an opportunity to pay more than the minimum. So if I can get a personal loan of 600,000 and pay 10,000, then it means I can do the same thing with a mortgage. I can get a mortgage of 600,000, whereby the installment, the minimum installment for the mortgage was 4,000, and I can afford to pay 10,000 this side. I can still do the same, pay 10,000 and be out in 6 years, just like I would have with a personal loan. So based on the risk profile and the rate, the advantages that comes with a mortgage, I would go with a mortgage, but I'll pay it within 6 years, just I would do with a personal loan.
Maybe you've touched a bit on my next question, but I would like for you to now focus on the disadvantages of either one of these loans.
I don't know whether to say it's a disadvantage, because a lot of people find that applying for a mortgage is sort of like too cumbersome. The conditions, it comes with a lot of conditions, and that's one thing that is deterring a lot of people from getting mortgages. First of all, sometimes depending on the location, if you are in Gaborone or closer surrounding areas in Gaborone, you can get 100% of the value of the mortgage that you are applying for. But the further you go to villages, that is called loan to value. That loan to value is going to reduce. You're only going to be given maybe 80% of the value depending on the location. You go as far as Mau, you are now given 70% of the value. So it means that you need to raise this 30% of the value. Where is that money going to come from? Either you save for it, and I've seen a lot of people taking personal loan and a mortgage, because now a personal loan is paying the 30% and the 70% is a mortgage. That's the reality that we face, because you are not financed 100%. That's one of the disadvantages of a mortgage if you look outside Gaborone. And then the other disadvantage of a mortgage is it comes with a lot of closing costs. What we call closing costs is you're going to have to pay valuation of the property. Yeah, that's a cost to you. You're going to have to pay what we call transfer. Their property will have to be transferred to you as the buyer, so that's a transfer cost. You're going to have to pay what we call bond registration fee, because remember, this property that you are buying is not yours for the entire duration of the loan. It's bonded to the bank, so that is also going to come with a fee. We call it bond registration fee. So we're looking at like 3 fees. And not only that, you also have to get like 2 types of insurance. The first insurance is credit life cover, or you can just get a pure life cover, of which a life cover is applicable in both loans, both personal loan and a mortgage. However, for a mortgage, you're also going to get an additional insurance, what we call homeowner's property. This is now insurance that protects the property, the structure itself, against fire, theft, and all of those things, because the property is wearing off, and the property, there's so many risks that the property is exposed to. So the banker or your financier want to make sure that the property is protected. So those are, the fees that comes with a mortgage, and the process of applying for a mortgage. I think that's one thing that we look at as a disadvantage. But for me, it's looking at your best interest. You go through all these processes because your financier is also looking to protect you. The personal loan is quick. It's really quick. So as you go there, you get into your financier, they will assess, and then once you qualify, they'll start processing. Maybe within a day or 2, you get your money. But with a mortgage, the length of time, you're going to have to go through the deeds office. It can take maybe a month to 3 months while you're still applying for it. But this one is much quicker. But the disadvantage is really, for me, is the pricing of the personal loan that is too high, compared to a mortgage.
Kumar, in your opinion as a financial educator, what would your expert advice be for somebody who's trying to buy a house, especially their first house? Would you say it's better to use a mortgage loan or a personal loan to make that purchase?
My advice would be get a mortgage. Even though, yes, you would say the terms and conditions is cumbersome, get a mortgage. Pay extra towards that mortgage, get out as quick as you can.